Hi and welcome to episode 7 of Ask Paul. Today is our third episode in relation to pensions. We're going to discuss investments and how to invest your pension the best way. Before I get into the nitty-gritty of investing your pension, I just want to say that everyone's going to be different, and that's a really big important message to come across from investments. Is that everyone's going to be different and different unique circumstances. So not one size portfolio, one size investment plan will suit everybody. So it's important if you are speaking with a financial advisor to get the best advice that's for you. And a financial advisor will typically take you through what's called a risk profile questionnaire to try and get your appetite for risk. And what does that mean? It basically means how you feel with risk and how you associate your money increasing and decreasing with your personal and kind of professional view. So are you comfortable with your money increasing and decreasing, or are you happy with your money just being safe all the time? And that's what those type of risk profile questions are there to pull out. One thing I will say though is what I've heard as well over the years from an awful lot of clients is that my dad lost all his pension, or my mum lost all her pension, or a friend of a friend lost all their pension because of the markets. You don't actually have to risk your money. You don't have to invest your money in equities or shares or property. You can simply sit in a cash account, and that means your money will be 100% safe. If you're doing that, I suppose the real thing you're missing out is the opportunity to get compound interest on growth. So typically if you invest your money, you're going to get more growth than if you just sit in cash. But if that's important to you, make sure your financial advisor are aware of that. And there's no harm in sitting in cash. One way to look at your pension is that you're obviously going to get tax relief from the government, as we discussed in the first two videos. You're going to get tax relief, so that means if you get 40% tax relief or 20% tax relief, you could view that as your growth. And so we're getting 40 or 20% back from the revenue, so that's enough. We're going to sit in cash and not worry about investment markets going up and down and all that kind of stuff. Obviously, you have a bit less in your pension, but the journey is the most important for you with your pension plan, making sure you're comfortable and making sure you're not losing sleepless nights and not losing sleep at night to make sure that your pensions get invested in the correct way. So that's the first thing. Second thing, if you're going to go into the markets, we're going to have a discussion around what type, if you're going to go into investments, what type of investment strategies are there for you. So there's different asset classes. And my asset classes mean equities, which are stocks and shares, property, commodities, and bonds and cash. Again, touching on the cash thing again, you can just go into cash. If you're going to go into the other asset classes, it's probably best that you diversify, so you pick a bit of each asset class. And this is kind of typical, don't put all your eggs in one basket. The reason why you do that is that if one part of the structure falls, so if equities have a bad year, property might have a better year, so therefore you're not all down. If you're in equities purely and you lose a lot of money on it, well then that's going to happen to your whole portfolio if equities are down a lot. So diversification is the key thing. The other thing we're going to look at is de-risking your pension over time. What I mean by that is, again, is if you're going to retire at age 65, well, 10 years before that, this is common kind of advice you get from a lot of financial advisors, is take 10% a year away from a risk strategy and put it into cash. So if, say at age 55, you have 4 categories, and you have, say, equities, bonds, property and commodities in a portfolio, take 10% a year out and put it in cash. That means by the time you get to 60, you'll have 50% of your money invested and 50% in cash. So if anything kind of really badly goes wrong, like it did in 2007, 2008 with the financial crisis, at least 50% of your money is safe. And then obviously as you go along the years, you get to 64, 90% will be safe and 10% will be in the markets. So that's a good thing. It's called lifestyling strategies with most of the life insurance companies in Ireland. The one thing I will say about lifestyle is be careful that you're not just ticking a box on an application form that's going to happen to you. Some people might not want to retire at age 65, they might want to go at 67 or 70, or they might want to go at 60. So it's important that you review, and you're going to hear this at the end of every video, review your pension or review your investment strategies with your financial advisor every year to make sure that your goals are the same every year. An awful lot of things can change in 12 months from a circumstance point of view. You might have got a bonus, you might have got maybe you're looking at retiring early because you want to spend more time with your family, whatever that is. Make sure your financial advisor knows that, because they can fit your investment strategy around your own personal circumstances, and that's always key. I hope you found this video informative. If you did, please like and share it with your family and friends. Any questions at all, please don't hesitate to comment below, or maybe get in contact through direct mail or email questions@askpaul.ie. Please like us on Facebook, Twitter, Instagram, and click back in for our next video on charging structures on pensions over the next couple of days. Thank you.